Hi, everybody. Welcome, welcome, welcome. I'm so excited you are all here. Ted's back with us this week. Yay. Tony, nice to see you. Vidal, it's always good to have you here, and I'm sure a few more people will be coming on. We had a last minute cancel, and so you get to have me today. Isn't that exciting? It's been a long time since I've been able to share with you. And we're going to talk about money because that's my favorite. Next to the favorite subject, my favorite subject's real estate. Money comes in second. And how I look at money is a tool. And what do you do with tools? You make them work. So we're going to discuss the money. You're going to get involved. Yay. And it'll be fun. Let's have a fun time with this, because what we're looking for is making money, the tool money, work for us, and to make that tool create other tools. So like that. So here we go. Where's all our ladies today? Huh? Anyway, we'll see you all when you come on. We have a gal that's going to bring on a note. So that's one way to make money. And we're going to have a little discussion about that note. Just a list of things that make money are your Roth IRA. If you have a Roth IRA, your Roth IRA does not pay taxes. So any money that it earns is tax-free because it was after-tax dollars. You already paid for that before you went into the self-directed Roth IRA. We suggest the self-directed because you get to say where the money goes. Most of the planners want your money to control rather than you control it. And let me tell you, the only person that cares that much about your money is you. So believe me, when you hire somebody to take care of your money, how do you know that they really are going to take care of it? So you could acquire more money by having a job. You could acquire money by saving that money. If you do work a W-2 and you have a company that is matching, find out what they match. Some companies match 3%. Some people match 7%. I've heard 10%. I've actually even heard 100%. I'd like to know what companies that is. So it's free money. People have told me, oh, I can't afford to put that percent in. You can't afford not to. If you're being matched 7% on the money you put in, and you put your 7% in and they match your 7%, that's free money. You just doubled your money. What a tool that is. So you need to be able to match. So when you're interviewing for a company, ask them, do you have a matching? And how does that work? And what do I get to say where it gets invested? And do you have a Roth? Because it's after-tax dollars. If you look at what that regular traditional is, the pre-tax dollars, check with your accountant and find out how much you're going to save by putting your money into a pre-tax. I would say that I saved about 3 cents on the $2,000 I got to add every year when Roth and traditionals first started. So I don't think it was really worth it. If it's going to cost you a dinner, or if you're going to save a dinner, my own opinion would be that it's not worth putting your money into a traditional. Put your money into a Roth, because what are you saving? 50 or 60 bucks. But be sure to check, because it may be worth it. Don't forget, whatever it earns during its lifetime, you will have to pay taxes on the earnings also. Whereas in the Roth, you don't have to pay those earnings. You look like Douglas. What's that frown about? Are you doing something else? And that's what you're frowning at? Or are you
sorry, my computer froze up for me. My internet's not cooperating, so I'm sorry about that, Peggy.
Oh, okay. Well, I don't want you.
No, I heard what you're saying, so I'm sorry.
Okay. Oh, it's all right. So another way to make money is property. You could buy property. You could buy land. There's 15 or 20 different assets: industrial, multifamily. You could buy a single family home. You could buy a house that you do like an Airbnb. You could be in manufacturing and that kind of industrial, or just warehouse where you have somebody like Amazon renting from you. Here comes Claire. So any of that kind of real estate, the value of it grows over time. We call that appreciation. You never know what the appreciation is going to be until you have an appraisal, but it does grow over time. I do recall that my grandparents paid about $5,000 for their custom-built home in New York back during the original Depression in the 20s, 29 or something. The last time the house sold was for about $1.5 million, and that was 20 years ago. So that's property that appreciates. It just grows like that. You could put your money in a savings account, and if you pick the right savings account, it will grow also. If you put it in the bank, it'll take a little longer to get there than if you were to invest, let's say, with a 10% return on your money. So look at that, look at the safety of it. Remember, when you're buying pieces of property or investing with other people that have property, you're secured by the property. You're one of the owners of the property. So that's a really good tool to have. And there's life insurance. So I was hoping that Ethan would be on today. We'll see. So there's different kinds of insurance. There's an annuity. So you put your money into an annuity, and when you get to be a certain retirement age, you could get cash flow on that. So that grows over time. You put money in and it keeps earning interest and earning interest. You could be in a whole life savings account that will earn money twice. Once the life insurance company will pay you, let's say 5% annually. You keep adding to that insurance policy. And every time you put money in, you get a higher cash value. You could borrow against that higher cash value, and you could invest that into something, real estate. I like real estate, so I'm going to keep saying real estate. And then you could pay yourself back as that project earns money. And then when the capital comes in, you have to pay the taxes on the capital, but not on the money you're paying back. So that's a great tool to have. And the earlier you start it, like when you're 0 years old, by the time you're 18, you'll be paying for your own college. And you could use it for a lot of other things, buying cars and buying homes and like that. You can't put your money in the stock market. We just happen to think that's very volatile, because if the stock goes down that you bought, you just lost your principal. And always remember how long it takes to earn that money and hold it. And we call that a depletion. And we think kids are a depletion. I know you love your children. Toys are a depletion. Another great way, and I think that Clarence will like this, is a great way for your tools to work is a 1031. 1031 exchange. It's called a like-kind exchange, and people get very confused about it. They say a like-kind. So the IRS says a like-kind is whatever you're selling, you need to buy again. And what they have said in their IRS code is you cannot exchange it for personal property. You can't exchange for an RV. You can't exchange for a boat. You can't exchange for gems or artwork. You must exchange for real estate. So you could own a piece of land and buy a multifamily. You could have a multifamily and buy an industrial. Real estate for real estate. That's all it has to be. It's really very simple. Don't complicate it. And then we have this really exciting thing. Claire, are you with us yet? Here comes Marcy. Oh, yes. Marcy and I talked today, and we talked about how important when you work for a company and they do matching, that you have that free money coming in, how important it is. So there's another way for you to make for your tool to work of money, and that's to buy notes. You could buy non-performing notes, or you could buy performing notes. You could buy from somebody that's all they do is buy and sell notes. You could buy from an owner who's got a note. You could sell parts of the note. So let's say you had a 30-year note, you could say sell the first 15 years of that note. Claire, can you share? We have a note. We're going to show you a note so you can see how it grows. We thought if you had an example.
There I am.
All right. Can you share that note?
I can.
Okay.
Do you want go
Yeah,
ahead.
This is Claire Cheney. Claire's got a show on Mondays called, what's your show called? I just come on it.
Deal of the week.
Deal of the week. And this was the deal of her week yesterday. So I thought this would be a great example of how you can make your tool of money grow. This was a pretty nice deal, actually.
Yeah. Did you want me to actually bring up the
Just
PowerPoint or just discuss it?
Just
I
the note. I just wanted you to bring up the note so we could all see it.
Okay. Then I need to, yeah, you think I was prepared even though I knew about this for 24 hours? No.
Okay, well, get prepared. And
give me 5 minutes.
no, it's
at the
fine.
most.
You do that, and when you're ready, just pop on. So is there anything you think that I might have missed that would be a good tool for your money? Cliff, you always have ideas.
I'm
Doug,
ready when you are.
Oh, I'll turn it over to Claire then.
Claire, you ready?
Hold that thought though. Yes. Now, what do you want? Do you want this specific note just to talk
Yes.
about rather than notes in general, right?
No, just a specific note. So we just already said note's a way to have, note is a tool to make your money grow. So we're going to
Right.
show you how you can make that money grow. It's really quite simple. Now, all a note is, and I know most of you know what it is, but just to clarify, there it is. It's a promise to pay. That's it. That's why it's called a promissory note. I promise to pay. Okay, can you flip down to the note itself?
I can.
Okay, good. So this note is an actual note. If you are at all interested or know somebody that buys and sells notes, which we do, and probably will end up going to them. And here is this
There
the
you
note? Okay.
This is the note. So this is on a home in Cleveland through a friend that I know there. And the current balance on the note is $29,250 as of April. The original sale amount was 37. They put some down and she financed $31,750. The borrower, as of now, has made 4 on-time payments. Now, with notes, most people look for 6 months, but she's just ready to cash out, so she thought she'd throw it out there. That started January 23rd or January 2023. The asset is at 1267 East 58th in Cleveland. It's a single family. The area has been getting a lot of attention from flippers. There's been a lot. Cleveland really, they're always the last in line as things expand. Cleveland and Detroit more so, which is a whole nother story, but are the last to kind of get on the bandwagon. Well, Cleveland's getting very much on the bandwagon and has been doing a lot of rehabbing in East Cleveland and in this area of wait a minute. This is East Cleveland. West Cleveland has been getting more, and this has been getting some also. Anyway, point being that there are some fabulous houses in Cleveland that have been horribly neglected, and those have caught the imagination of the flippers, and they're so nice when they're done. Anyway, this is in that area. It's also a good rental area. So anyway, the anticipated ARV is in the 65 to 76 range. So this is a low end. This is something that one of the reasons this is an owner carry, which it is that you can't get this kind of bank. The bank's not going to back in this. It's just too low. So the borrower is a buy and hold fixer. So he's fixing this house up with the idea of renting it out. So the note originally was at a 0% interest, which I'm sure interests nobody. So the way this is working, so try to follow, because this is where it gets hard to wrap your head around a note sometimes. So the borrower is paying $500 a month. Anyone who has their financial calculator can pull it out and start filling in these numbers. They pay $500 a month every month, and they're also paying insurance, which is not included in that. They do that separately.
And taxes are paying that separately too. Yes. Claire, we lost you. I don't know if you're muted. Where'd you go, Claire? Claire, you're muted. There you are.
Is there a problem?
Yeah, you were muted, so we couldn't hear you. So the borrower paying $500 a month
Sorry.
first, and paying for the insurance and paying for the taxes, I presume, also.
Right.
Okay.
So they're acting as the owner like you would anytime you buy a house. So yeah, they are covering all that, but we made sure, or she made sure rather that they had the insurance. Contract for deed, a lot of people don't love, but at this low end thing, it actually makes things so much simpler. And it also means if they don't pay, you just take the house back. There's no big, long, expensive foreclosure situation. The house is yours, and you can resell it or do what you want with it, because that is your protection. The note is offered at $20,000. So if you recall, the face value, the actual value of the note today is $29,250. But the owner is willing to sell it for $20,000. That's 68% of its current value, which is a good, pretty decent percentage on a performing note in particular. It's a very good percentage on a performing note. The remaining payments are 60 months. And so the return over 60 months at $500 a month at $20,000 is 17.27%. So for a performing note, that's actually an excellent return and very little hassle involved.
So if you see this property, this note was paying 0 interest. That's how it originated, at 0. She just wanted to get her money out of it, and she was willing to carry it back. But this is how you make money grow. She's going to get $20,000, which means she's taking a discount on the property itself. And now you get to buy it at $20,000 for an almost $30,000 note. So you're actually going to get the full value of the $29,250 because the tenant or the owner of the property is not getting a discount on the payment. So that's what makes this a great tool. A note is a great tool. You have any questions?
Yeah, that's what I like, is that you're just taking it. Nothing changed. Just like when you get a loan with Chase and then they sell it to B of A or they sell it to whoever, nothing changes. You just keep paying a different person the exact same amount. We had a problem with that last night with people wrapping their head around it. This group probably gets it better perhaps. But anyway, that is that note. So I will stop the share so everybody can talk and ask questions.
Yeah. So do you have any questions about that tool? Yes, Clarence, I knew you would be the first.
Why is the insurance so expensive?
I don't know. I don't know much about Ohio insurance. And I don't know if that's $178 a month or $178 a year. I really don't know. Or $178 every 6 months. I'm not sure.
Okay, and as far as the taxes, they're paying the taxes, correct?
Yes, because they bought the house just like you did when you bought your house, even though the bank more or less owns it in its way.
You would be the bank. Yeah, so here's another tool. If you have children and you want your children to go to college, for instance, and you bought this note at the $20,000 and you opened a savings account where they could actually make a little money, maybe even in a money market, you could put all the payments in there and they would come out with this $29,000 plus that 17% interest. So I don't know, I didn't get my calculator and add it all up, but it seems to me it would add up to about $35,000 or $40,000. Yes, Ted.
The way I read it, that's not plus the interest. The interest is built into the discount.
The interest
You get back your principal.
Yeah, you get back the principal plus the interest.
No.
You get
Well, the
back
principal,
29,
it
you get back
becomes
29.5
$20,000.
for a $20,000
Oh,
payment.
I see. Okay. But it would
Yeah.
be a 17%, right? Because it started off at 0 interest.
Essentially, you're buying a discounted obligation.
Exactly. Any,
Another question.
yes,
So-
go ahead.
You say there's 60 payments left. The original note was 29.5. There have been $400 or $500 payments.
The original note was 31.7, I think.
Okay. And if there's 60 payments left times 500, that would be 30,000.
Yeah, it's
Okay.
actually 59.37 or something like that. Payments left, and I thought I'm not putting that in a presentation, so I changed it to 60.
Okay.
Like that. Yeah,
Yeah, so that last payment would be slightly less than 500.
a tiny bit.
But good catch, because it matters if the math is right, you know?
Yeah, exactly. And that they keep paying. And of course, the best thing would be, well, this is just me, that they don't pay, they move out. Now you've got a house that's fairly fixed up and now you could sell it for 60,000, but hey, and carry that whole thing back, but with interest. A lot of people I know that do contract for deed end up with a house for 25, 30, 35 years or longer and have several people move in, always fixing the house up, always adding value to it. And then they just decide it's time to leave and they move on. They never ask for any money back because they're not going to get it anyway. And it's a great way. It's a great tool to have a contract for deed. You know, you said some people don't like it, but it can be an enormous moneymaker, a great tool.
And especially on these low priced houses, because the expense of a foreclosure in some ways is hardly worth it. So this saves that expense should it come to that.
Yep, exactly. Yeah, you can't get a loan for under $100,000 from a bank. There's private money. If you could go find the private money, it's probably, I don't know right now if it'd be more expensive than a bank. It was several months ago. So you had a thought, Cliff. What is that? More
I was going to
tools.
say the private money resources that I'm familiar with, they are typically more expensive than a bank, but they're a lot more flexible than banks typically are.
Oh, yes.
That's
Yeah.
true. Yeah, I was talking to someone the other day and I was talking to this gal. She said, oh, well, I don't know about my credit and this and that. And I said, well, all they care about is the property. They don't care.
Yeah, a private money lender may not look at credit. They may actually look at your experience and, are you capable of working with a team? How many projects have you successfully completed?
Exactly.
The money that you're looking to borrow right now, is it consistent with the same asset class you've had experience and exposure in? If it's not, you probably won't get a loan. If it is, and you've been successful, your chance of getting a loan would be much higher. So, private money definitely has its advantages. Trade-off is you're going to pay a lot more in interest typically.
Yeah, and they have a certain time frame they want you to hold the money. So that makes you
Yeah.
a tool. In this case, that makes you the tool.
Yeah.
And if you don't have that experience, then you better go find somebody that's got that experience so that you could get that money, because there's plenty of people out there willing to lend that money, but they want the experience. That's what they want. All of
Joint
us.
venture. Just joint venture with someone that's got what you don't have.
Right. And split it with them until you get enough. Yes, Ted. And then Marcy.
The way I've summarized it kind of this way: the reason why bank interest rates tend to be relatively low is because the bank's assumption is that he will not have to chase the borrower for payment. The borrower voluntarily pays. The people who lend into, let's say, other markets have to take into consideration what sort of costs are involved for them to do collection work when the borrower does not pay. And that's by and large the difference between the bank and the loan shark. The higher rates are because the loan shark assumes he's going to have to chase the borrower, but he's also got some tools that to use for collection that the bank typically doesn't have or won't use.
So why are you calling them sharks?
Sharks have teeth.
Not all of them
That-
are sharks.
well,
It's
A lot of people can't get money anywhere else. Because of, just like this person, they can never get any money anywhere else. So are they working with a shark? Or are they working with
The-
somebody that really
Well,
wants them to be
the reason they
successful?
can't get any money anywhere else is because whatever their circumstances are, let's say puts them in a position where the lender is afraid he's going to have to do something to, let's say, enforce collection that the bank typically doesn't have to do because the borrower pays voluntarily.
So no bank will lend under $100,000.
Well, so some will, but they generally 50 would be a minimum, I would think, at the
Oh,
most.
we haven't
But
found that
in the
at all.
Midwest, sometimes
Maybe. Yeah, we
Uh,
haven't found that.
local banks more
We've
than.
tried- Yeah, we've done everything we can for a couple different people. We could
Oh,
not.
really?
find A US bank that would lend on anything under 100, not
Wow.
even 75, yeah. Yeah, Marcy,
Unmute.
yeah. I just want to clarify something in terms of experience. Some people say, oh, yes, I've had experience. I did all the paperwork and I did this and I did that. And I ask, is your name on the contract? Well, no, does not count as experience. Thank you for Cliff for acknowledging that by nodding your head.
Oh,
So
absolutely.
just a clarification.
thank you.
You're
Good
welcome.
to know that. Yeah, so make sure you're on the contract.
Right.
Clarence, what you got for us?
Well, I'm just wondering if Nathan or Cindy Coleman are on this call, and I don't think they are, but
Neither.
particularly Nathan, since he just made a presentation. And Claire, are you just shopping this for somebody? Or are you brokering it? Are you going to be involved with it? Are you willing to buy part of it? What's
No, I'm actually involved in this particular thing as a principal. So a friend of mine and I ended up with this house. It's actually her house. I was partnering with her. She had gotten it very, very cheap a while ago. I think she bought it. She might have gotten it for back taxes or something. And we were going through her portfolio and decided this was a good one to try to sell. And that's when she found the flipper who wanted to do a buy something to get ready for rental in an upcoming neighborhood. And that's it was really good timing for him and for her. And so she
I'm
decided
sorry.
she just wanted to cash out on it
Okay.
for a number of reasons. But
Yeah, and I asked her to come on because we were talking about tools that make your money grow.
no, that's good.
And notes are a tool, and she happened to have it yesterday, and I knew I was going to do this today, so I just asked her to come on and show it. It's available if anybody's interested and wants that conversation. Just let me know, put your info in the chat, and we'll send it over to Claire, and you could have that conversation.
yeah,
Did-
it is a specialized niche in real estate that you have to wrap your head around. But if you dive into it, a lot of people do very well just buying either performing or non-performing notes. And it's nice and passive. It's something you can do in your office. You don't have to be driving all over the place like some.
Yeah, it looks like the down payment was over $5,000. Is that correct?
It was just about 5, yeah.
Was it actual cash?
Yes.
Okay, so the people that bought it, they bought it at 37,000 and they put down a down payment, closing cost, and all that good stuff.
Right.
Okay.
And your concern?
Well, my concern, the type of deal where this would work for someone like me is if there was someone experienced in the new Ohio and wanted to buy this note, I would put up money for, 80, 90% of the note. And then I would just partner up with the person that wanted to put up the other 20% or raise it and manage it. So I'm pretty much passive, and I want to remain passive, but I'm just, if Nathan were back on this call, I would be asking him what he thought and why he wasn't trying to raise money to buy this note. Now, he might have a different program. He might not be the right person for this, but anyway, those are my thoughts.
And what is the 20% you want somebody to come in for?
Well, because I don't want them to go away if life gets difficult. So if it's a sponsor, we'll call them a sponsor, somebody that really knows and understands notes, and someone that's willing to look into this and feels they can understand this area and this particular deal. If they wanted to raise money, I would be an investor up to 80%.
And then somebody could bring in the other 20%.
They could bring
If
in the other
something
20.
happens, you want them to be the active person then to resell the property. Is that what I'm gathering from you?
I want them to do everything, and I want them to be married to the property.
But they don't own the property.
They own the note, and the property secures the note. So whatever it takes. I mean, if it just flows through, what I would think, I think the play on this is to buy the note, season it further, and resell it.
Yeah, that's it. See, there's another way to make it grow.
Well, yeah, and so I think that would be the play. But if they wanted to just hold the note for the 5 years, they could do that as well. I would just ride along as a participating limited partner, or
Okay.
I hate to use that word, and I'm just thinking out loud.
No, and I'm asking you because I want you to think out loud, because everybody has a different way to look at things. And that is why I asked the why about that 20%, because a lot of people don't think about a note being split like that.
Right.
They think it's 100% or nothing, but it isn't 100%.
Right.
What you didn't bring up, because obviously that's not part of what you would want, is to sell some of the payments. But there's many times where somebody just wants some of the payments because they just want that cash flow. So there's so many different things you could do with a note, just tons of things you could do with a note.
Sure.
And my guess would be that, I don't know if that's true or not, but at some point, this person that fixes up this home and gets it up to where they're going to get, let's say, $800 a month on it, and have that extra $300 in their own pocket, maybe would do a refi at some point. Who knows?
Probably have to have a 12 to 24 month seasoning before they did that.
Or they might get enough down payment from the seller to pay it off, and then they would carry it back. But who knows? I mean, this is what we're talking about today, how you make money work, how you make it grow. It's a tool. People think they have to earn it and then they spend it so they don't have anything. But the whole idea is money is a tool that actually could grow. So you might have a hammer that's just so big and it doesn't turn into a sledgehammer. You got to go out and buy the sledgehammer. But the idea of money and whatever you're investing it in, you could make it grow from a regular hammer to a sledgehammer to, to something else that's even larger. Money works for itself and it can grow. And what most people don't understand is how to make that tool work for them. And I know most of you do, but I, love to talk about money. So here you are talking about
preaching to the choir, Peggy.
I know. Yeah, well,
that's okay. We'll listen.
And look, there's so many different ways to do notes too. Just that in itself, if you think about it, The same with all the housing where people are buying single family houses. If you look at all the different things they do, they buy a house, they rent it out for a year at a time. They buy a house, they turn it into an Airbnb. They buy a house, they add more rooms to it and they rent it out by the room. I mean, if you look at all the different things that you could do with any kind of a property, how you can make it grow. It's really simple to make it grow. It doesn't take that much except some imagination and getting the permits, basically, if you think about it. So that's it. Anybody have any comments or questions? Oh,
I think
good.
Ted, you got a comment on that?
We're listening.
One of the things to keep in mind, let's say, if you're investing, essentially you're starting a business. If you're investing in notes, you're becoming a banker.
That's right.
All businesses, or let's say good businesses, run, from my point of view at any rate, on the let's say with a figure that kind of looks like a tripod. One leg is sales, one leg is production, third leg is administration, and all of those legs have costs associated with them. In the case of buying a note, your revenue is the interest. Okay. And the question is there enough revenue to cover all the costs that you have to incur in order to run the business? Maybe it's a very simple business and maybe it has relatively little cost associated with it. That's great. Okay. But the biggest cost that is a contingency relative to investing in notes is collection. What do you do in case the borrower doesn't pay?
Yeah, that's Clarence's concern. You do what you have to do. That's why.
Don't assume that there's no cost associated with your investing, because there are.
That's why
tax point of view, maybe from a tax point of view, unfortunately, there's an awful lot of the costs that aren't deductible.
So the reason they put this in a contract for deed was so that foreclosure could be avoided. That's one of the things that they thought about. Somebody I work with says she always looks, she never closes on a property unless she has 2 exit strategies. So same with a note, you need to know your exit strategy. Clarence's exit strategy is have somebody be a partner that's going to handle the problem. That's his strategy. And then
contracts are based on the assumption that promises are going to be kept. Then you get into the situation of what do you do if one or more of the party, if one of the parties,
so Ted, what do you do?
Doesn't keep the promise. That
What
just
do you
gets
do?
expensive. It gets expensive.
So Ted, how about a resolve? What do you do? So what are some things you would do if you were in that situation?
Well, I don't live in Cleveland, so that I would probably not try to get involved in a situation like that, because
Ted, you're avoiding the answer.
Yeah.
It doesn't
Yeah,
matter
you're
what the
throwing out a lot of
property is.
problems, Ted. Let's hear the solutions.
Yeah, we know what the problems are. That's why we deal with them ahead. So we got our 2 or 3 strategies to exit. So that's what we're asking you. What's a strategy you would use to handle that if it became a problem? It doesn't matter where the property is. It's not about the property. It's about the strategies.
well, I would look in the first place to see what the capacity of the borrower is, let's say, to repay with little effort.
Okay.
And the less information you give me, the less interested I am in the deal.
Very good. Simple. Thank you. What you got, Cliff?
I was going to say, you can just do a risk assessment as part of your due diligence before you take on the note, and then, adjust the interest rate accordingly. And, the higher the risk, the higher the interest, the lower the risk, you can actually work with the interest and lower the interest if you really needed to, just to be competitive. And then, by holding the note yourself, it puts you in a very strong position of control, because if they can't make the payment, you can always have a conversation with the borrower and see if a loan modification could actually help them You know, maybe they're going through a hard time, and maybe you can actually create something that a bank normally wouldn't be able to create that would allow them to ride through a difficult time, and maybe tack on, you know, whatever they can't pay on the back end. So it gives you some options.
Yeah, quite a few there.
Yeah.
Fred, what you got?
I mean, one strategy that I've seen here in Texas anyway is as part of the loan agreements, you can structure in a purchase option for the lender so that if the borrower defaults on repayment of the loan, it gives you another avenue rather than a foreclosure, which we all know can be expensive and time consuming. It gives you the option to step in and purchase the property directly at an agreed upon price ahead of time.
Well, you're the one. I'm confused on that one. See, this is notes always, there's always some avenue of notes that will grab me and say, what? And that's one of them. So purchase from whom? From the buyer of the home, I assume. The buyer bought this home for $37,000. What would that look like then? You have we'll call it the 20. We'll say it's the $20,000 note.
Well, I'm speaking about a more of a loan against you know, that is secured by a property.
Right.
So
But I don't know why you'd buy the property. You're the lender. How do you buy it? You already own it, more or less. The lender, you've got all the rights to the property. You don't need to buy it.
It's an avenue to take ownership, to take full ownership of the property as an alternative to foreclosing. So if you're not getting repaid and the borrower is not paying you, this goes to the point of how expensive it is to chase someone, as Ted was mentioning.
Okay, got it.
Then you can essentially purchase that property at an agreed upon price. I guess maybe I'm getting confused a little bit with the note here and how that would work differently. I'm thinking about it from the standpoint of for example, if I've lent money to someone and they used it to buy a house, and then they're repaying me, and then they stop repaying me, I have a couple of options. I can try to talk to them and amend the agreement, as someone said, to make it more suitable for them if their circumstances have changed. I can foreclose on them if I want and simply take ownership of the house completely and sell it to recoup my loan or my investment that I have lent them. And this provides another avenue to that can be quicker and cheaper, and maybe in the long run more profitable for me as a lender.
To go in and buy it at a price.
At a discount to the loan amount, or to the an agreed upon discount to the appraised value of the property.
Yeah, so he's just in this case, Claire, he's protecting the borrower from a foreclosure, and he's then also protecting their credit, because they won't have a foreclosure on their property, by actually purchasing the property.
So it is almost cash for keys in a way.
Yes.
Let me ask you if this is what you're talking about. It's a $200,000 house. You've lent them $100,000. Let's say you're the only lien holder on the house.
Right.
And so they can't pay. Something happened. They've got to move to North Carolina today, whatever the situation is. And you say, okay, I will give you $150 for this house, and you can go. So essentially you're really giving them $50. And then they would sign the deed over to you, kind of something like that, like a quick claim, or do you go through a different process?
I mean, you would specify it in the loan agreements and the purchase option.
Well, sure, but is that what it would look like when it came time?
At the end of the day, yes. You would buy the house. You would buy the house in your example. You'd buy the house for $150,000. They'd be responsible for all the closing costs. If they weren't in a position to pay those, you would pay them, but simply deduct it in addition from what you were buying the house for. And in the end, you would end up owning the house for net 150, then you could turn around and sell the house for
For the two.
or the two.
Or whatever. Uh-huh.
Right.
Okay,
So
okay, I see. That's interesting.
Yeah, it's just another way. And what's it costing you? You have closing costs, so you're probably going to give them 43,000. And now you've got the house that you probably could sell if it's been a few years for a few thousand more. It's not a bad way to go, as long as you've got that extra money sitting in an account. And it's work and it's time, because now you have to resell it, or you're going to hire an agent. It's going to cost you, all that again. Kind
Yeah, I
of.
mean, that's why you're buying it at a discount, right?
Yep, absolutely.
To cover all the hassles and risks. You're not, if you believe, at least this is the way I think of it, if you believe the ARV is accurate of 200, you're not taking a significant risk if you believe you can sell it timely, within a month or two of getting it. There's always a risk the market could move on you, but that time frame is pretty short. And so it's really just a hassle factor that you're compensating yourself for, as long as it's laid out clearly in the agreements that the borrower is the one responsible for all closing costs. Then you're walking away with the house at 150, and if you believe you can sell it at 200, then that's your compensation for the risk and the hassles that you're now taking because they were unable to fulfill their obligation to repay you.
Well, I can tell you Clarence is out on that one because he doesn't want to deal with the hassle. What, Clarence? We can't hear you. You're muted or something. Or your sound's down. I love that. I never thought of doing something like that, Fred. I think that's really interesting and thought-provoking.
I would never have thought of putting that into a contract ahead of time at all.
Fred's very
Under remedies. Would you put it under remedies?
Yeah, that would be a remedy. Oh, you mean in the contract?
Yeah.
I mean, I used it in a transaction last year, and it was basically structured as a separate purchase option agreement, just like as if it was, imagine a purchase option contract on a property. It was negotiated like that on a separate standalone specific contract. That was an addendum to the loan agreement.
Okay.
An exhibit, and it was referenced in the loan agreement in the event of a default. Like any default, the buyer or the borrower has, the ability to cure defaults, and the lender has to give them the ability to cure defaults. And so in this case, it's a default of repayment. And in the event of a default, the borrower has this option available. The lender has this option available to them if a default occurs and it goes uncured within the time frame provided by the agreements.
That's interesting. I like it.
I mean, at a minimum, it gives you as a lender, it gives you more leverage to, I've got someone ringing my doorbell. It gives you more leverage to bring the borrower to the table to deal seriously with you. Because they know that if they're not returning your calls or if they're not making payments when they're supposed to, you have this option available to you. So it just makes them, more serious. You're not chasing them as much. That's how I looked at it.
That's great. I think it's a great idea. Never heard of it before. So Clarence, are you unmuted now? And
Am I? Can
yeah,
you hear me?
you are.
Yeah. I don't think I caught all the details, but he was talking about an option to buy if they default. And I guess that would be in lieu of just foreclosing on them.
Yep, it is.
Yeah, it's probably, particularly good in certain states where you get strung out forever. Although,
yep. And it can be a win-win for everybody.
Yeah.
Which
Yeah.
is, it's another, it's not a contract for deed, but it's kind of set up that. Not doing the foreclosures that are paying. Yes, Ted.
That to me, an amusing thought is that if you have a 20-page contract, probably page 1 defines what the parties agree to, and the other 19 pages, if it's done well, tell what people can do when the promises on page 1 aren't kept.
Yes, well, my
If you could do
opinion
that in-
is if it's more than 3 pages, it's far too long. No matter whether it's a PPM or a mortgage.
And the courts get involved when people can't agree. There's a joke line that says one attorney in town starves, 2 attorneys in town get rich.
Yes,
My attorney says, if everyone's unhappy at the end of the negotiation, then they've done their job.
And he gets paid.
Right.
and he
He's
gets,
happy.
right. John Swingle, you are here. You came in a little late, so you probably missed 90% of us talking about money as a tool and what that tool can do. And then we got onto a note just showing how money could grow. And then that's kind of where we're finishing up. So welcome. I think you're muted. We can't hear you.
Hey, maybe a good way to summarize it. It's the way we used to teach kids in Little League Baseball. So you tend to play the way you practice. Okay, it's not practice that makes perfect. It's perfect practice that makes perfect. So we need to do the proper things when it doesn't matter, so that when it does matter, we are more likely to do the proper things.
We're practiced. Yes, well practiced. John, are you unmuted now, do you think? No, you're not. Maybe your sound's down.
He's unmuted, but he's not coming through.
Well, I'm not the tech person, but we're happy you're here. And we have recorded this, so if there is a replay on YouTube. And I don't think we have, do we have your email address so we can send you the replay? Okay, we'll do that. Any other comments? Because we are at the top of the hour. And we're so happy you came. And next week we have, oh, it couldn't be Douglas Dowell that's speaking next week. Could it possibly be? Yes, it could. And he is going to be talking about risk, which we know you got this tool you're using. That's right. We can hardly wait for you to come on because, I have a follow-up I'm really anxious to hear what you have to say because I thought, the next week after you are on, you can keep this in mind while you speak. Or I thought the following week, it might be fun to ask each person what they consider risk for them and what they do for due diligence or any of that, unless you're having that as part of your, it was a thought, because risk.
That's a good follow-on discussion. I'm a little more esoteric, I think, in what I'm working on right now for our presentation.
Okay. However it goes, it'll go. So thank you all for coming, and
Fun stuff.
And I'm so happy to be here, and I'd be happy to return anytime.